Fire up YouTube and search foreclosure, and you'll find some daunting headlines. 371% surge in foreclosure starts. Foreclosure report, shocking, and no escape, foreclosures now coming, just to name a few. Are foreclosures something we really need to worry about? The best way to start to analyze the potential for a coming wave of foreclosures is to break down the current pipeline of loans and observe forming trends. But that's not enough. We also need to study home prices, the inventory of homes for sale, mortgage interest rates, and the economy, specifically employment rates. Today's quarterly analysis of the mortgage market, relying heavily on the Black Knight Mortgage Monitor, yields everything you need to know to be prepared for the impact of foreclosures on the U.S. housing market. The first chart in our report is an overview that Black Knight uses on its cover of September's Mortgage Monitor. The mortgage delinquency rate fell yet again to 2.78%, well below pre-pandemic levels, and just 3 basis points off of May's record low. This should be a bit surprising to people watching those hype videos on YouTube. So let's examine what Black Knight reports about our headline. That's foreclosure starts are changing. Black Knight reports that foreclosure starts dropped more than 9%, and September's 18,000 starts remained 53% below pre-pandemic levels. As a reminder on tracking foreclosure sales, we track starts at the beginning of the foreclosure process and foreclosure sales to get an early warning on growth in the foreclosures pipeline. Most starts do not result in a foreclosure sale, but it is still good relative information to track. So foreclosure starts are changing, just not how the hypesters want you to believe they're changing. Prepayment activity is down 73% year over year versus September of last year. Not surprising, as mortgage interest rates have doubled plus in that time span, reducing the benefit of refinancing for most homeowners. The dwindling supply of distressed property, coupled with rising mortgage interest rates, has cooled the refinance activities that had been the top solution for delinquent borrowers. Before we move on, let me emphasize the importance of each graph in today's report. These graphs collectively contain the facts about what's happening in the pipeline where we would see foreclosures gaining strength. They are not as exciting as the hype that most online reports present, but they do reflect the truth. This graph plots the national delinquency rate on first lien mortgages, demonstrating very positive trends in the U.S. mortgage pipeline. In this graph, the dark line plots the quarterly delinquency rate. The light green line plots the average delinquency rate recorded from 2000 through 2005, and the gray line plots the record low delinquency rate. Black Knight provides the 2000 to 2005 average as a reference to what the market looked like before the housing bubble, so we have a basis for forecasting the next similar market behavior. Here's what Black Knight reports. The national delinquency rate fell to 2.78% in September, down 1 basis point from August, and just 3 basis points off the record low set in May earlier this year. The delinquency rate decline in September ran counter to the typical growth of 27 basis points that was averaged from 2000 to 2005. The national delinquency rate is now 41% lower than pre-Great Recession September average of 4.66%. These three observations demonstrate a strengthening housing market in terms of distressed properties and rebuff claims that a flood of foreclosures is heading our way. But let's dig deeper. This graph segments mortgage delinquencies by severity. The number of 30-day delinquencies rose just 1% last month, while the 90-day delinquent loans fell 1.5% and are now 24% above pre-pandemic levels. Foreclosure starts declined by 9% to 18,000, holding the line at 3% of serious delinquencies in September, down slightly month over month and less than half pre-pandemic levels. An important point that most YouTube hypesters either fail to understand or perhaps purposely overlook in the reporting is that the market anticipated much greater foreclosure activity this year due to a stockpile of delinquent loans that were not addressed over the past 2 years. Once COVID hit in March 2020, lenders were not allowed to foreclose on most home loans that were delinquent during the pandemic until this year. So the decline in foreclosures is the opposite of market expectations, and I'll address the why later in this report. The number of delinquencies has been reduced by more than half since the start of the pandemic 2 years ago, and delinquencies are now lower than pre-pandemic levels. That's the teal line in the graph. Serious delinquencies, those that have been delinquent for more than 90 days, continue to fall and are approaching the pre-pandemic level. If you're a longtime subscriber, then you know I review the mortgage pipeline each quarter because we get early insight into coming problems by keeping an eye on what's going on with mortgage payments. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to evaluate the facts and ignore the hype porn that is so prevalent online, then subscribe now and I'll keep you in the know. Now let's talk for a minute about loan forbearance. Forbearance plans are agreements between borrowers and lenders that, for a set period, allow the non-payment or partial payment of a loan to help borrowers retain their homes. Many lenders used the forbearance process as a quick fix when COVID hit the U.S. and many jobs were temporarily lost. More than 8.4 million borrowers entered into forbearance agreements with their lenders. It was not long ago that hypesters on YouTube claimed that forbearance plans would lead to millions of foreclosures that would crush the housing market. Back when it all started, I released a video explaining why forbearance plans would not result in foreclosures. So let's see how it has played out. This graph plots the number of loans on active forbearance plans. There were nearly 5 million borrowers who went into forbearance at one point early in the pandemic. Forbearance leading to foreclosures was all the hype on YouTube for more than a year, but it never materialized. None of those reporters considered the other factors involved, like equity in the housing market and the diminished supply of homes for sale. The 515,000 remaining borrowers on forbearance plans are 20% fewer than what we reported 3 months ago and now measure at just 1% of all active mortgage loans. The remaining pipeline of loans in forbearance should decline by about 70,000 per month and soon will be a footnote in the housing market history. As you'll see in the following pie chart, the forbearance plan was successful in protecting homeowners during the initial days of the pandemic. This pie chart reveals what happened to the millions of loans in forbearance that were COVID-related. 8.3 million borrowers have been in forbearance at some point since the onset of the pandemic. 93% have since exited their plan, with more than half returning to making mortgage payments, 1/3 having paid off their mortgages in full, 6% are still on plans, 7% are working through loss mitigation, and just 1%, that's 94,000 loans, are in foreclosure. For all those reporters who came forward with foreclosure warnings when loans en masse went into forbearance, I'm curious about what were they thinking? The U.S. housing market is flush with equity, so it was not likely to see foreclosures even as a worst-case scenario. For the majority of those that were not able to make their payments on their homes, they could have sold their homes, paid off the debt, and walked away with a good deal of money. This is what I reported right after the forbearance plans went into effect, yet most other experts were expecting, or at least proclaiming, that the market would collapse. False or ignorant reporting is rampant across every industry, as anybody can post an opinion online. My recommendation: stick with the facts and ignore the hype. Whether or not you believe that the U.S. is in a recession, after all the experts do not agree, you do have to acknowledge that there is ample fear about the stability of the U.S. economy. Regarding real estate, and home sales in particular, I focus on employment, as most people rely on their earnings to pay for housing. This graph plots the average annual unemployment rate for each year since 1991. The blue dashed line reveals that the average unemployment rate for the past 31 years is 5.8%, a whopping 58% higher than this year's average of 3.66%. Looking closely at this year in the graph, you'll see that we are very near a 30-year low. The economy might be in grave danger, or perhaps it's the best it's ever been. What I know is that a high percentage of people have jobs, and continued high employment levels will likely work to push home prices and rents even higher. This graph is the Black Knight Home Price Index. It parallels the results from several other data sources that I use. It plots the 1-month percentage change in home prices in blue, recorded on the right vertical axis, and the annual home price growth rate in green, recorded on the left vertical axis. Housing market watchers are split on whether we will see meaningful price declines in the coming months or even years due to low affordability or a more lateral correction moderated by historically low inventory. September's data brought fodder for both sides of the debate, with home prices slipping for a third consecutive month, but at just 0.5%, less than half the monthly decline seen in July and August. All in all, prices have fallen 2.6% since June, the first 3-month decline since 30-year rates spiked to nearly 5% in late 2018, and the worst 3-month stretch since early 2009. Over that same 3-month span, the median home price fell by $11,560. Annualized appreciation slowed to 10.7%, still more than twice long-term norms, and while indicative of continued correction, the 1.2% decline from August is the smallest seen in 4 months. We know that real estate is local, and that means price changes might be different in your area than they are in others. These two tables list the most and least affordable cities when comparing payment-to-income ratios. The first thing that caught my attention is that more than half of the least affordable cities are in California, while none of the most affordable cities are located in California. I often get comments on our channel telling me that I'm wrong on home prices, and when I ask most of them where they live, it's usually Western states, and specifically California. It's important to study trends in the U.S. housing market, but make your purchases and sale decisions based upon your local housing market data. One way to measure home affordability over time is to examine the ratio between monthly mortgage payments and borrowers' income. We refer to this as the payment-to-income ratio. This graph plots the national payment-to-income ratio. It is measured as the share of median income needed to make the monthly principal and interest payment on purchasing the median price home using a 20% down 30-year fixed-rate mortgage at the prevailing interest rate. With 30-year rates nearing 7%, it takes roughly 39% of the median household income to make the principal and interest payment on the average or median priced home, the highest such share since 1984 and well above the long-term average of just under 25%. The last time affordability was this tight, 30-year rates were over 13%, roughly twice today's 30-year fixed mortgage interest rate. Buying power has been cut an additional 14% by rate increases, even as home prices have pulled back from June 2022 peaks, and today's buying power is now down 38% from last year. To put that into perspective, somebody shopping for a $400,000 home last year must now cut their budget to shop for a $250,000 home, and that's a home that was worth $235,000 a year ago. The monthly principal and interest payment on the average home purchased with 20% down is up $937, marking the sharpest annual rise on record dating back to mid-1970s. Since the data for this graph was pulled in late October, we have seen mortgage interest rates come down nearly 0.5%. Regardless of today's exact rate, the U.S. housing market continues to run extremely tight from an affordability perspective. One way to forecast future home prices, as well as the likelihood of a foreclosure crisis, is to evaluate the existing supply of homes for sale and compare it with the current demand rate. This graph plots the current supply and demand for homes in the U.S. The blue bars measure the number of active home listings on the left vertical axis, while the red line plots the months of supply of homes by using current sales data and is reported on the right vertical axis. Finally, the gray dashed line measures the 1-year average of the months of supply. Unfortunately, we still see the trend falling in the supply of homes relative to the current demand rate. The numerous reports across the internet warning of rising inventories are either wrong or very local to specific markets. More on that in a minute. Currently, the supply of homes for sale relative to the current demand rate is still falling. When we look at the far right of the graph, the blue bars show that the current inventory of homes is right at 1 million homes. Contrast today's supply with the 4 million plus homes in inventory at its highest point back in June 2007. That means today's supply is 75% lower than the market observed at its peak and lower than any time going back 23 years. It's very hard to anticipate a near future rush of foreclosures when the market is desperate for more inventory. Growth rates are universally coming down across the country, though some markets are more resilient than others. What many confuse when discussing falling home price growth rates is that most markets are not seeing falling home prices. Rather, they are seeing the rate at which home prices grow coming down. One extreme example is Miami, Florida. You can see it at the bottom right of the graph, where the growth rate is down to 23% year over year. Migratory inflow and corresponding lack of inventory continue to put upward pressure on prices on many markets. If prices held steady at their current levels, it would take until early February or March 2023 for the annual home price growth rate to hit its long-run average, and until April for price growth to be down year over year. This graph was not part of the Black Knight report, but it reveals why we're not worried about a foreclosure crisis today, and while the current market is vastly different from conditions observed in 2009. It plots both equity and debt in the housing market, and all we need to do is a now versus then study to see why today's conditions are so different from the housing market recovery more than 10 years ago. From 2006 through 2014, there was no equity in the housing market. Simply put, Americans owed more on their homes than the homes were worth. If a homeowner became delinquent, no solution made lenders whole again. Foreclosures resulted in losses to the borrower and the lenders. Today's completely the opposite. There's equity again in the housing market, and more so than at any time in the past. For most borrowers who become delinquent today, the remedy does not have to be a foreclosure sale. Instead, delinquent borrowers can sell their homes on the open market, repay their debt, and many will walk away with cash. Black Knight continues to report the supporting data that demonstrates foreclosures are not a concern for the U.S. housing market. Again, I reiterate that there is a housing crisis, but it's not one of defaults and foreclosures. Rather, it is one of historically low supply, soaring home prices, soaring rents, all leading to the devastating decline of home affordability. I expect to see people with great credit being forced into the for-rent market simply because there are not enough homes to be found at affordable prices. This increase in demand in the rental market will continue to push rents higher at an unhealthy rate, and we'll see lower wage earners struggle to find adequate housing. Wall Street is making a big push into housing, and what has traditionally been a greatly decentralized housing market will see big business gain market share, leading to implementing controls that will make it harder for many Americans to afford a home. Big corporations like Amazon are not only hurting local retail businesses, they are now attacking housing, perhaps the last of the untouched small business community. Foreclosures and forbearance loans were protected by rising prices and diminished inventories of homes for sale. But what will protect us from big business coming in and buying up a large segment of our local housing markets? This should be your primary concern for housing, not the distracting hype about foreclosures, forbearances, and prices crashing. If you think I've presented a sound argument in this video, please share it with your close friends and family. If you think I've missed something important, please tell me how by leaving a comment below. If you want to see a video explaining the mistake of pricing a home on the nines, you can view it by clicking on the box in the top left corner of your screen. To see a video debunking 6 housing market rumors, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.